You find a setup that looks perfect. The technicals align, the candlestick breaks out, and you click buy. Almost immediately, the price reverses and stops you out. The trade failed because you were looking at the surface waves, completely blind to the massive river current flowing in the exact opposite direction underneath. On a price chart, individual candlesticks are those chaotic surface waves. Surviving as a trader requires the ability to see past that noise and track the deep underlying direction of the market. By the end of this video, you will have built a professional 3-line moving average system. It is designed to instantly filter out bad trades and highlight high-probability entry zones. Open your preferred charting software right now, select any asset you like, and follow along to configure your screen with me. Taking positions without a visual trend filter leaves you entirely exposed to the dominant momentum of institutional traders. We are going to fix that right now. This chart shows a single blue line smoothly cutting directly through the volatile, jagged clusters of price candlesticks. This is a moving average. It calculates the average price over a specific number of periods, smoothing out the erratic daily movements to reveal the asset's true trajectory. Before we build the system, you have to make a choice. Trading platforms offer two main types of moving averages: the simple moving average, or SMA, and the exponential moving average, or EMA. This image shows exactly why active traders avoid the SMA. A simple moving average takes the price from 10 days ago and gives it the exact same mathematical weight as today's price. Because of that equal weighting, the line is slower moving, and its signals lag far behind real-time market shifts. This chart shows the alternative. Notice how the green EMA line drops sharply, hugging the falling price candles much tighter than the red and blue SMA lines. The exponential moving average places heavier mathematical weight on recent price action, allowing it to react quickly to sudden changes in momentum. In financial markets, speed is your primary advantage. Relying on lagging SMA data is a liability, which is why professionals use the EMA. Step 1. Go to your Indicators tab and add 3 separate EMAs to your chart. Configure their period lengths to 21, 50, and 200, and assign a distinct color to each line. Each length serves a specific purpose. The 21 period tracks aggressive short-term momentum. The 50 maps medium-term swing trends. The 200 is your institutional baseline. We start with the 200 EMA because it dictates your absolute market bias. This is the single most important rule of the setup. Here is the trend filter rule. If the price candles are trading above the 200 EMA, you only look for long or buy setups. If the price falls below the 200 EMA, you exclusively look for short or sell setups. It is exactly like coasting downhill on a bicycle. You go with the slope, not against it. Enforcing this rule completely eliminates the temptation to catch falling knives or short strong rallies. It keeps your capital aligned with the dominant market momentum. Now that we have our macro direction locked in, we use the 21 and 50 EMAs to pinpoint our exact trade entry zones. Most traders draw horizontal lines for support and resistance. EMAs provide dynamic support and resistance, zones that physically move up and down alongside the price action. This chart shows a bullish entry setup. The price surges, then naturally pulls back to rest on the upward-sloping blue 50-day moving average. The candles are consistently holding above the line, proving the buyers are still defending the trend. Here is the bearish equivalent. Look at the orange highlighted peaks. Rising green candles strike the blue 50 EMA ceiling and get rejected downward. This underlying momentum acts like a downward escalator, continuously pushing the overall structure back into profitability. The space right at the 21 and 50 EMA lines is not a random gap on the chart. Those are highly calculated strike zones for executing your entries. No trend lasts forever. To complete this system, you need a visual trigger that tells you when the macro trend is collapsing. This chart shows exactly what that looks like. Watch the intersection where the blue 50-day line arcs upward and crosses directly over the black 200-day line. This specific event is called a golden cross. When the faster medium-term average overtakes the slow institutional baseline, algorithms and professional funds recognize it as a confirmed transition into new, long-term bullish momentum. The inverse is a death cross. When the 50 EMA crosses below the 200 EMA, The market is signaling the onset of a prolonged bearish cycle. Crossover signals take time to develop on the chart, but when they appear, they confirm that the underlying tide of the market has shifted entirely. Look back at the chart you opened at the start of this video. What was once a chaotic mess of candlesticks is now a clean, professional workspace. You have your checklist. Consult the 200 EMA to lock in your buy or sell bias, use the 21 and 50 EMAs to locate your dynamic entry zones, and monitor the line crossovers to spot macroeconomic reversals. Moving averages do not predict the future. They process the volatile data the market is currently generating and organize it so you can verify the true direction of the asset. Right now, pull up the chart of an asset you currently hold, compare its current price to the 200 EMA, and let me know in the comments below whether you are technically sitting in a bullish or bearish trend. By applying this simple 3-line system, you guarantee that you always have the clarity to trade with the current and never against it.